Hi, I'm Steve, and welcome to Bytes by Standard Chartered's Global Chief Investment Office. How should investors prepare for a weaker USD? The first half of 2025 marked the worst USD performance in over 50 years, following a long period of strength. By January, the USD had risen about 50% in real terms, against a trade-weighted basket of major US trade partners since mid-2011, setting up a shift toward a structurally weaker dollar. Here are a couple of key observations. USD is currently overvalued. The Bank for International Settlements real effective exchange rate shows the USD near the previous peak level from February 2002, implying continued overvaluation even after this year's sell-off. Reserve currency status has weakened, not disappeared. The USD status as the world's premier reserve currency remains intact, but its advantages, deep markets, regulatory infrastructure, predictable policy, have eroded somewhat in recent months, reducing the certainty around its dominance. US balance of payments has deteriorated. The US net international investment position worsened due to fiscal stimulus that boosted domestic demand and widened the current account deficit, meaning the US must attract substantial foreign capital inflows to prevent a weaker dollar. A weaker USD tends to bolster non-US assets. Across portfolios, weaker USD environments are typically positive for most investments and tend to favor non-US assets relative to US assets. Portfolio stance: ensure exposure to non-US assets and gold. Retain more selective US exposure. Consider increasing allocation to non-US equities, notably Asia ex-Japan and gold, while trimming US equities due to high valuations and tariff risks. Yet, US equities are still retained for their innovation and historically better performance in a weak USD. Hedging USD exposure. Hedging USD exposure for equities is generally not advised, since a weaker USD can lift overseas profits when translated back to a weaker currency. For USD bonds and deposits, hedging can matter, but costs are a constraint. A measured approach, perhaps using short-term USD strength to adjust hedge ratios, is recommended. Also, diversify deposits across currencies. Emotional and cognitive management matters. A diversified, multi-currency portfolio helps cope with FX swings. Track performance across currencies, for example, USD, GBP, SGD, to distinguish pure FX moves from asset returns, reducing the risk of overreacting to short-term fluctuations. What should investors do? Increase global diversification with a tilt toward non-US equities, especially Asia ex-Japan. Consider gold as a hedge. And carefully evaluate hedging for USD-denominated bonds or deposits. However, the US remains a large, innovative market. Tariff dynamics and valuation levels add uncertainty. Hedging costs can erode returns. The path of structural USD weakness is not guaranteed. Thanks for watching. See you in the next episode.